Hi to IPO subscribers. Welcome to eaglelive.ai. Today, let us review IPO from Complete Sports and Management India Limited. Here we go on IPO review. This is the financial analysis of the company generated by AI Powered Software. So this company has been categorized as a healthy company. Very good. That is what investors require. And financial analysis. First, let us see health analysis, solvency. Solvency ensures sustainability of the company. Here, all the metrics are positive. So, the solvency is strong. Coming to liquidity position is also very good. Current ratio is 1.76, quick ratio is 1.5, very good. So, this is the reason why this company has been classified as a healthy company. Coming to operational efficiency, inventory turnover is a little bit low, 3.92, and the receivable turnover is negative. Generally, we expect 78, but it is 3.77. It's okay, no problem. So, financial irregularities, that is financial frauds. So, software has not identified any financial irregularities from the financial statements of the company. So, profitability, EBITDA 25.82, EBIT is 25.56, PBT is 24.44, PAT is 18.18, cash profit 18.44, EPS 12.11, and EBITDA margin 21.73, net profit margin 15.81, ROC is 14.97, ROE is 53.55, and book value per share 28.45. Okay, cash flow from operating activities minus 3.65 crores, and net cash flow for the year is minus 2.3 lakh crore, not crore. It lakhs. Okay. So coming to market values, market price is 135, and based on that market price earning ratio is coming to 11.14. Very good. And price to book value 4.7. Wow. Price to book value is at higher side. Let us see projected P and PB, and we can have an opinion on that. So coming to growth indicators, sales growth is 6.5. In general, we expect more than 10. Otherwise, growth indicators are okay. Good. So this is the financial status of the company. Company is a healthy company. So financial is fundamentally strong. Let us go on IPO review now. Yeah, this is the IPO review on Complete Sports and Management India Limited. CMSML IPO attractive PE, strong growth potential, but our cash flows and risks a concern. Let us see what are the cash flows problems. Business overview, what they do. Complete Sports and Management Limited operates in the amusement, entertainment, and leisure equipment space. The company sources, trades, and distributes equipment from domestic and international manufacturers. It also provides installation, commissioning, maintenance, and consulting services. Product portfolio includes bowling system, arcade and gaming equipment, trampoline parks, soft play areas, laser tag, and go-karting, bumper cars, cashless gaming systems. Customers include family entertainment centers, hotels, resorts, clubs, corporate and residential projects. So the business is positioned to benefit from rising demand for experience-based entertainment and indoor leisure destination. It's good line of activity. Growth story. The opportunity is attractive. Rising disposable income, higher leisure spending, more entertainment centers, more demand for amusement equipment. Expansion of indoor entertainment and FECs can support long-term demand. CSML is also expanding its equipment base and plans to establish Duckpin, the bowling bistro in Mumbai. The company therefore has both equipment distribution and entertainment center expansion opportunities. IPO and use of funds. IPO size is 74.93 crores. Price band is 128 to 135. Fresh issue provides will primarily be used for 39.88 crores gaming and other capital equipment for Vivendi warehouse, 8.09 for Duckpin Bowling Metro Mumbai, 11.5 crores for debt repayment, balance general expenditure. Only 11.5 is for debt repayment. Balance amount is most of the amount is for installation of additional equipment. So the company can have some additional revenue from the investments, and investor take away most of the money is being deployed towards expansion. Yes, very good. While a portion of goes towards the reducing debt. Okay, and they can save the interest also to the extra tiny extent. So valuation, the key attraction at 135 share, EPS 11.96, PE 11.28. And this is the biggest positive in the valuation story. For a company showing strong recent earnings growth, 11 PE ratio earnings multiples appears reasonable rather than expensive, but PB is 4.77. In general, how much it should be? It should be less than 3. The company is trading at a significant premium to its book value, so the valuation picture is PE attractive, PB expensive. Growth adjusted valuation. If the company can sustain the growth assumptions provided, 33% CAGR, projected P is 8.49, that could make today's valuation look considerably more attractive. Valuation metric, CSML is not a deep value IPO, but the current PE provides reasonable valuation comfort. Okay. Financial picture. Recent reported figures show improving profitability with the financial year 26 revenue around 115.2 crore and PAT around 17.95 crore. Very good. Positive. Strong recent profit growth, healthy profitability, attractive earnings, multiple expansion plans. Concern, historical negative operating cash flows, receivables outstanding for more than 3 months, and profit growth needs to translate into actual cash generation. Of course, receivables more than 3 months, one should think of that because cash flow, if it gets delayed, no? Receiving the cash of the receivables delayed, it will have its own impact on the regular operations of the company. So, key investor question, are earnings converting into cash? That's what. Key is cash flow risk. The company has experienced negative cash flows in the past. Receivables outstanding for more than 3 months could put pressure on working capital. And the governance risk, past delays in statutory filing and payments requires monitoring. And it's common, this is in all the companies it is there. Related party risk also is there in all the companies. Subsidy risk, loss-making subsidies, group companies could affect consolidated performance. This is a risky. So loss-making subsidy means that's a little bit negative aspect. Debt is a risk. The company still has borrowings obligations, although part of the IPO process will be used for repayment. If the company, as long as the company can earn the profits, so servicing the debt is DSR is also very good. They're servicing the debt as per schedule, no problem. So debt may not be that much a problem for the company. Market sentiment, current sentiment, neutral to positive. The broader Indian IPO market is currently active. August 2026 has seen a strong IPO pipeline with more than 21,000 crore reportedly raised across 20 issues, reflecting renewed primarily market activity. Yes, capital market is very good. Number of IPOs are coming. And however, CSML whole subscription data is not yet available because the IPO is scheduled to open on August 28, 26. Current sources also show no meaningful GMT signal at. Therefore, fundamental sentiment positive, valuation sentiment positive, cash flow sentiment cautious, GMP subscription sentiment not yet established. Promoter and ownership. Promoter holding remains high after the issue, very good. Higher promoter ownership indicates strong promoter commitment. However, investors should balance this positive with the related party and governance risk. And final investor scorecard, business model positive, industry growth positive, revenue growth positive, profitability positive, PE valuation attractive, PB valuation expensive, cash flow concern, and governance moderate risk, growth potential promising, and market sentiment neutral to positive, and overall subscribe with the caution. Final conclusion. CMSML IPO attractive valuation but watch cash flows. Why consider? Cash flows, the problem is only because the booklets are due for more than 3 months. That is the only reason. And otherwise, even debt repayment is also they're doing time to time. See, when they are doing debt payments, that is DSR, servicing the debt is by time to time, that that indicates that the companies have a required cash inflows and everything is okay. And why consider growing amusement and leisure market, diversified product portfolio, strong recent profitability, expansion-oriented IPO proceeds, P of 11.3 looks attractive. So why be cautious? High PB of 4.77. Here you are paying a little bit higher amount for investments. So in general should be 3, no, which is 4.7. So historical negative cash flows, receivables at risk, governance, compliance concern, execution risk and expansion plans. Final view at 11 earning ratio, price earning ratio, CSML offers a reasonable valuation comfort, but investors should subscribe only if they are compatible with the cash flow and execution risk. Execution risk is not a problem. Cash flows, the only thing is that receivables, they should minimize the period. So that's the only reason. So closing line for the video, attractive PO, promising growth, but can CSML convert profit into cash? So that's the problems always there. But receivables are like 3 months is okay. If it is more than 3 months or say 6 months, then there's a problem and the profit may not convert into cash. But here the company is doing very well. Of course, final decision is yours. Do you subscribe? So it's you who should take the decision. So we are given whatever we can give. So as always, investment decision should be based on your own financial goals and risk tolerance. Thank you very much for watching the video. If you found this analysis useful, please like the video, subscribe to the channel, and stay connected for more detailed IPO and stock market basis. We are here to protect and safeguard your investment, safeguard your hard-earned money from investing in a wrong company.